Next up, Kevin Hahn is going to share with us some insights into crypto and crypto investing and some of the basics, some of the things that, you know, even if you are an expert, good to see what the latest is. Kevin actually by day is a portfolio manager at Lombard Odler, and by night he's part of BlockSauce, which is a due diligence and research foundation focused on blockchain and cryptocurrency space. He can probably tell you a little bit more color about exactly what he does every day, but everybody welcome Kevin Hahn.
Thank you, Jay. Yeah, so quickly, my name's Kevin Hahn. By day, I am a portfolio manager at Lombard ODA. Lombard ODA is a Swiss asset manager based out of Geneva. We have around 200 billion plus of assets under management. I work out of the New York office, managing a dedicated healthcare portfolio, long-short equity, and by night, just like many of you, crypto enthusiast, and really got involved in the space about 2 years ago. BlockSauce is a research and due diligence foundation. We also do help with advisory of tokens, everything from white papers to marketing, recruiting developers, and token design. So my lawyers said that I had to make a disclaimer, so I will make that now. All the statements and opinions that I talk about today are solely mine. They do not represent Lombard ODA or BlockSauce, and none of this should be taken as either financial advice or tax advice. Okay. So I guess before I go deeper into it, I'm just curious how many of you actually trade and or hold, you know, some crypto assets, just so I can get a feel for. Okay, so you know, most of you guys, half of you guys. So maybe I can start with what I do. How does it apply to crypto? What got me attracted into it? So in the traditional equity space, by the way, Lombard does not have anything related to blockchain in my daily functions. So really managing a healthcare portfolio, but really equities. And John, just a second ago, kind of mentioned the differences between stocks and crypto. But before I got in, as a portfolio manager and meeting with companies and getting pitches from multiple companies every day about why I should invest in their asset or their company, I've come to develop a very skeptical lens at every token or ICO that's kind of thrown at us. So the first one I had to start with was with Bitcoin, because that was the king and the father, and that revolutionized the whole space and brought blockchain to us. So with that lens, I had to think about, okay, well, if I'm looking at a traditional asset like an equity, I have to figure out what is the value of that asset. And if that value is higher than what the market is currently pricing it, that's when I decide to invest, because at some point I expect the market to catch up to what I really believe, or my thesis. So in crypto, it's very hard because Bitcoin intrinsically has no value. It doesn't mean it doesn't have any value. It just doesn't produce a cash, or doesn't throw off any type of return that you can model in Excel. So what is Bitcoin trying to disrupt? If I think that the internet disrupted information and the value, the transfer of information, then Bitcoin disrupts value and the transfer of value. So value meaning, and what most people use today for transfer of value is money or cash or any form of asset that you can peg to a certain price. So if I think about how to value Bitcoin in itself, that's where I first started. Well, you can't value something that doesn't throw off any cash, so then you have to rely on the market to give you a certain price. And how do you get to that price? Well, for the first place I started was thinking about the money supply in the world and all the assets that are in the world and what's that worth. So Credit Suisse put out a report, a little bit under $300 trillion of value in the whole market. That includes hard assets like gold, real estate, cash and cash equivalents, securities, commodities, derivatives, and et cetera. So when I think about, okay, well, $400 billion for the cryptocurrency market, 180 or 200 for Bitcoin, and I compare that to 300 trillion, okay, so it seems like there's some room that I have some margin of safety, right? But will crypto eventually take over the whole market? There are some people that would say yes, and some people that would say somewhere in between. So then I had to go and figure out, okay, where is that in between? What is the easiest or most logical next step for disruption? So I looked at gold because, as this archaic storage of value, it seemed like Bitcoin was being the digital gold. It was the easiest to disrupt. That's an $8 trillion market. So again, I feel pretty safe in that assumption. And then going through the rest of the money supply, you start to notice offshore banking, another $20 trillion market. So if you're Amazon or Apple, you have cash overseas. Let's say you have cash in random country where you might be doing business. One day the government wakes up and says, Apple, you infringed on one of our local company's patents. We are going to hold your cash in escrow. Well, now as Apple and you want to unlock your cash, you have no access to it. So now this gives a really big and immediate and disruptive use case for corporates to really control their finances. But that's not only corporates, but that's also people as well, individuals, right? So you may be at any given point in time subject to some law where you are, not really being protected as an individual. So this gives you a little bit more protection of your own financial assets, right? So once I started doing that, it became a lot easier to digest the valuation argument. So what did I have to do next? Well, that started, once I decided, okay, you know what, I want to allocate some of my assets toward this space that seems to be very disruptive. The next question I had to ask is, how much of my assets do I need to allocate as my whole portfolio? So if I own real estate, I own stocks, bonds, et cetera, then I had to think about, okay, what is the right percentage of net worth that I should dedicate toward crypto? And that was a little bit tougher to decide because it is very volatile, so you have to stomach the volatility. Watching your portfolio go up and down 10, 20% a day is not something that most people can do and also do a day job, right? So given that I work in the equity space where we do deal with volatility, I guess it was a little bit easier for me, but still I had to take the approach of some safety or precaution. The Kelly criterion, if some of you guys have heard of it, is a very well-known concept that gamblers use to decide how much they should bet when the odds are in their favor. And this makes the assumption that when you make a bet, either it goes to zero or you're right. So using that basic concept, and the formula is based on how much conviction you have in whatever you're betting on and what your total pool of capital is. So using that and assuming that I don't know if I'm going to be right or wrong, using 50%, I decided, okay, I could comfortably get to 2 to 5% of my net worth in crypto and feel totally safe. So if 5% went to zero, then it's not going to change my life, right? So if you have a stock portfolio and you put 5% of that into crypto, and 5% goes to zero, or maybe 100% of your stock assets go down 5%, stock market can go down 5%, it's not going to change your life. So that's how I first kind of got into it, and that's where I started. And then as I started learning more about the technology, I got more interested in different various projects, and then all of a sudden I saw my crypto assets as a percentage of my net worth growing through either capital appreciation but also fresh investments. So then the next question that I had to think about was, how do I navigate the markets when they are so volatile? So John just talked about the volatility index of this stock market. And right now it's around 15, right? So I think 2017, Bitcoin registered a vol of around 100, meaning that at any given point in time, you should expect Bitcoin to move up and down 7%. Most ICOs had a vol of 200, 150, 200, meaning that you should expect it to go up 15%. And if you guys are mathematicians or statisticians, then you know that it's an average. So for every day that you have, your crypto doesn't move, you should expect a very large movement up or down of 30, 40%, et cetera. So knowing that, I had to think more longer term and adopt a VC model type of way to invest. And when you look at the VCs and private equity guys and how they invest, they typically spend a lot of time doing diligence on management, right? So, because at that given point in time, a lot of times you're investing on proof of concept or prototype, something that isn't out in the market yet. So, one of the things that I started doing was spending more time with the management teams, understanding their competencies and what they were trying to build, and trying to invest more in the managers rather than in the idea itself. Obviously, if the idea is great, that's even better, but do I believe that this management team has the corporate governance in place, the right incentives as well to actually maximize the value of their token? Because unlike equities, where in equities you have the SEC as a governing body to make sure that management is doing their best interests or serving their best interests for their clients, in the crypto world, you are not actually receiving any equity. Now, in the future, we will have equity-related crypto, so that will come out. T0 is one of the first that is trying to do that, right? So yeah, I did want to keep it open floor. So if you guys do have any questions, feel free to raise your hands. But I wanted to walk through some things that have helped me in, I guess, being more at ease with trading and management of a crypto portfolio. So one of the biggest differences that I think everyone should understand is there's a big difference between a trade and an investment. They are similar in nature, but they are quite different. Typically, the way I think about it is investment is a little bit more longer term. I am okay riding the volatility up and down. A trade has a very specific short-term time horizon and catalyst that I'm looking for that I will clearly define before I enter the trade. And before I put on the trade, I also think about what is my exit. So if I'm going to buy a token and I have no exit, then there's no liquidity event where I can actually capture those gains. So that's the one thing that everyone should think about when you are buying or selling a token is it a trade or is it an investment? Number two, risk and money management are key. So in a very volatile environment, the last thing you would want to happen is some financial ruin, meaning that you have drawn down your crypto portfolio so much that you no longer can play, or you have to put fresh assets to work. And that's not a situation everyone wants to be in. So that's for every individual to come up with their own risk management strategy. But typically, what I've done is, anytime I put into an asset that I don't really believe in, but I think is a trade, and it's down 30%, I just sell out completely. And that's just my own risk management that I do. I'm not saying that you guys should do that, but for me, if I'm putting on a trade and I think it's going to go up in the next 2-3 weeks, and it doesn't, then that means I misunderstood the market or misunderstood something about something that I didn't know about. So I just use that as a general rule for myself. On an investment side, I can stomach a little bit more because maybe my time horizon is 2 years out, and I'm okay writing 30% down. Number four, it's very easy to buy into pump and dumps because you're on Telegram chats, and you just have to be very cautious and wary of all the information you're getting. Always question who is giving you that information, and understand that it is biased information that's coming from whatever source you're listening to. Number 5, thesis creep. So what does that mean? In the traditional equity space, let's say I make an investment in a company, I expect certain catalysts to play out, and maybe one of those catalysts don't play out, but then I convince myself, because now I'm biased emotionally, I made the investment. I say, okay, well, the company did X, but X actually still supports my thesis. Well, that would be considered thesis creep, because in the beginning, before I made that investment, I said, this is what I expect to happen. So put in ICO terms, let's say you talk to a management team, they say, we have a roadmap to get on 2 exchanges by the end of the first quarter. And let's say they get on let's say they get on 1 exchange by, April. So they missed their first deadline, and then they didn't even get 2. So at that point, that's something to highly consider whether or not I'm doing part of thesis creep. Now, is it because of some unforeseen event that is not under management's control and they were able to? Well, still thesis creep, but you have to at least understand that you are making that distinction, and you are making that specific call. Number 6, only realize that you only have to be right 51% of the time, right, to make money. If you made money, that's good. Everyone wants to make as much as possible, I understand that, but the best traders on Wall Street are right 51% of the time. So consider that as benchmarking your own self. And then when you think about a benchmark, this is another thing. When in the traditional space, you made money, that's great, but are you outperforming the market? That's what I have to live with every day and talk to my investors about is, they gave me money, they expect me to outperform. Am I outperforming, and what benchmark am I using? So some people might tell you, all right, just take the top 10 coins. But if you take the top 10 coins, if you take the top 10 companies in the S&P 500 or the Dow, they're mature companies that have cash flows and management teams, and they've been in business for 50, 100 years. In the crypto space, because it's so new, there's nothing like that. You take the top 10 coins, half of them are not, can you even consider them cryptos today? 2 of them don't even have mainnets, meaning they don't have their own token. 2 of them, 1 of them you could argue that is not even a cryptocurrency. And 2 of them, are very centralized, so it actually goes against the vision of decentralization that blockchain is supposed to do. So Coinbase recently launched an index with 4 currencies that may end up being the industry standard. We'll see, but at the very least, you should always look at your returns. Yes, it's fun to look at it as in a form of US dollars or whatever fiat currency you're used to. But at the end of the day, if you're investing in the space, you're investing in crypto. And so you should always, in my opinion, look at it as a relative to Bitcoin and maybe Ethereum. The next point, understand that the current market is very biased long. So anytime you do receive new information that might get you more bullish, always understand that that information may already be out there or it is already priced in. However, when you do receive negative news, consider that to be asymmetric in your risk reward, because since it's very difficult to short the crypto tokens today, most people are going to be long, and you're going to see more downside asymmetric risk than upside. Looking at valuations of comps. So one of the misconceptions in the equity space that some traditional fund managers do is they'll tell you, well, this company was trading at a PE of 10 at its lowest ever in its career. So PE is a valuation metric that a lot of equity analysts use to determine valuation, a quick way to determine valuation. But what you notice is that the best form historically of comping is relative to its peers in the current market environment rather than historicals, because historical PE multiples depend on interest rates and different host of factors, the dollar strength, et cetera, that are different in every given market environment. So typically the best way to comp is against other assets that are like it. So if you're looking at a decentralized exchange token, look at it amongst other decentralized exchange tokens, not against what it historically has been at relative to BTC or Ethereum. One other tip that has helped me in the traditional equity space is during times of correlation. So when a lot of assets are moving together in a similar fashion, most people think, oh, I need to go bet on the one that is going to give me the best return. But typically in very highly correlative markets, you want to diversify as much as possible because there's probably a relative catch-up move across the asset class. So if you are the type that are trading the top 10 coins and you start to see them trading in a similar fashion together, you would want to diversify your holdings to capture that alpha of the market. And then the last point I would say is on the risk side, staying away from frauds or black swan events where you could reduce your portfolio to nothing, whether exchange risk, et cetera, is something to highly consider. So one strategy that I use is, by the way, most of my, like 80% of my holdings are long-term, but 20% I decided to not day trade, but trade in a more frequent fashion. And the one rule that I have is don't put more than 10% of my trading bucket, so 2%, on any given exchange overnight. So you hear a lot about these frauds and hacks. You should be comforted by the fact that no one today has still hacked the Bitcoin network or any wallets. The only wallets that have been hacked are either because those people have put their private key on their phone and uploaded it. They got screen loggers or key loggers, screen captures. So if you're very secure with your private key, you will not get, it's very almost, I can say almost impossible for you to lose those tokens. But on an exchange, you are at the same risk as anyone else hacking your own email, right? So if I think about that, and for my own strategy, I put 2% maximum on an exchange, so that way if the exchange does go down, then at most I'm losing 2% of my portfolio. I guess one thing I can give kind of a, not a market view, but one thing that I think is very topical for the near term that people I think should be paying attention to is May 7th, which is next week, the SEC, CFTC will hold a hearing on whether or not Ripple and Ethereum and other ICO tokens will be considered a security. Why do I think that is important? Well, we're talking to people who are very close to the SEC, it seems that Bitcoin is not considered a security, and that's pretty well known. But there's still this lingering debate about whether Ethereum is. If you go by the Howey test, which is one of the most conservative tests that the SEC uses to determine whether or not something is a security, it basically says if a person invests in a common enterprise with the expectation of some profit in the future, that is considered a security. So I would, I encourage, as part of block size, I always encourage as part of our advisory that think about that test, think about how you are positioning your coin or your token. But why is that important? Because Ethereum was funded through an ICO, and everyone that put money into it expected some profit in the future. So the debate now is, will Ethereum be considered a security? If it is next week, then I'm not trying to freak everyone out, but you should expect some volatility and at least understand that that is a risk if you hold that token. Because if it is considered security, then there might be certain stipulations that come with new tokens that are using the ERC20 protocol on the Ethereum network. So the last thing I'll do, I gave a talk similar to this, but more on the regulatory side of crypto 2 weeks ago in New York, and comparing what's preventing institutional money from getting in. And the short answer is that there's no custodian solution that that is independently verifiable and trustworthy. So today in the equity space, if I buy a stock, like John said, it takes 3 days to settle. But I actually, if you come into our offices and say, hey, we want all your money, we actually don't have any because they're sitting with the banks. So our security certificates are sitting with the banks as well. They're our custodian. In the crypto space, you know, you've probably heard, not your keys, not your money. Well, if you give your keys away to a custodian, then you're basically giving your money away. And so if they get hacked or they get compromised, then you could have a risk of loss, even though it's not your fault. So that's why you see a lot of crypto funds today doing self-custody, because they understand this concept, and they will hold the keys themselves in a very secure manner. But the securities law post Bernie Madoff in the Ponzi scheme that he ran, the SEC came out with guidelines saying, if you are a fund with over 150 million in assets, you are required to have an independent custodian. So why am I bullish, I guess, medium to longer term this year? Because I think there are a lot of banks currently looking at this. They are looking at custodian solutions for these funds. And once you have that, then you have a vehicle for institutional money to come in and feel safe. So if anyone has any thoughts around that, it'd be super interesting to see how the market plays out. But I think that's one of the limiting factors for why we aren't seeing a rush. But 2 weeks ago, Goldman hired their head of digital assets. So things are brewing. And for the guys that have been around for a while or newer that aren't used to this volatility, I would say when you compare, there's a lot of similarities between this and the internet cycle or bubble, that if you want to call it that, where you had a lot of companies early stage just adding .com on their name and seeing their valuations go up. A lot of times those companies just went bust, but out of that we had Facebook, Google, Amazon that are multiples from where it was in 1999. But if you think about the internet bubble, that was created by Wall Street to some certain extent, because they were going out and IPOing these companies. If you think about blockchain, it's like one of the first, and why the banks are so against it is, one, it directly threatens their business model. But number two is because you have a situation where the bankers can't sell any of these things to their clients because they're not the innovators in this. They aren't holding the keys to unlocking this value. So it will take time, and once they realize that their business models are a threat, I think you start to see more banks getting involved, and which is why you're starting to see that now, because there are some exchanges that are making more money than some of the banks, Binance as one of them, right?
Okay, do we have just a little bit of time? Any questions for Kevin?
So you mentioned earlier kind of the difficulty in shorting these things. Do you think that availability of mechanisms coming up, hopefully to improve shorting capabilities, is a good thing? Is going to help the market and bring in more institutional money?
The better, the more shorting that is available, the more liquidity that will enter the market. That will help reduce the volatility. As volatility comes down, you should see more people investing in this space, because they don't have to worry about big swings in their portfolio. But at the core, what's nice about shorting is that you can actually go out and take a bet against bad tokens or bad projects, right? So that makes that makes a better market in my view. It makes a more honest market. So once we get the custodian solutions in place, once you see more liquidity, I think that's just a natural progression.
And are you aware of any projects or anybody kind of trying to make that available soon?
Not the shorting side, but the custodian side, yes, there are a couple of, I guess, projects and/or institutions that are working on that.
Maybe one more. So, any other questions?
Maybe one last
Okay.
thing. So in my talk 2 weeks ago, I did something fun for the crowd. So I put Bitcoin into a wallet and created a puzzle that I dropped hints throughout my talk 2 weeks ago. And I looked this morning. I think it was 3 million satoshis. So It was $200 back then. It's a little bit more today, I think like less than 300. But I looked this morning and no one has cracked it. So I'm just going to drop the clues here again, and maybe someone here will figure it out. But the clues are: use your brain to claim the prize. Inside this wallet is 3 million Satoshis. For the passphrase, back to the Genesis, or your Coinbase or belong to us. Don't be salty, this is supposed to be fun. Remember this day and open sesame. So it's, I made my first Twitter post with these clues and the public address of the Bitcoin wallet. You can find me at Twitter _Kevin_Han. Thank you.
Thank you.